which has happened mainly coming from.
Patrick, thank you very much for being here today. You just had a fantastic presentation here at our event in London, and I could see everybody was very taking photos and trying to figure out the details of the presentations, and I want to discuss here. But before that, everybody knows CoStar, but I would like you to explain in your own words what's CoStar doing and how big you guys are, how can you help our audience?
Sure. Well, CoStar is a global real estate information, analytics, and news company. We gather data at an individual building level across North America, Europe, the UK, and other markets we're expanding into. We use that building level data to generate analytics. So where you might see other companies coming up with trends in the market, ours are actually generated from individual data points. And I'm part of the analytics team at CoStar. So my job is to take all of that building level info, work out what it means, and feed it back to our clients so they are better informed in terms of what's going on in the market.
Perfect. Back in January, I met a big sovereign wealth fund, and he said to me, it's time to go shopping now. I am buying offices in London, etc. And my question to you is he right? Have we hit bottom? Where are we at the real estate cycle?
That's what everybody wants to know, isn't it? And it's a really interesting question. If I had to answer it at the very, very highest level, I would say that we hit the bottom of the cycle in terms of the office market probably sometime in the beginning of last year. UK office leasing volumes increased during the course of the year to their highest level since 2021. Yields peaked sometime in the summer and have started to tighten since. But I think you have to be very careful when making these generalized statements because, for example, if you are holding a business park on the outskirts of Oxford, which is attracting lots of life sciences demand, you're probably very optimistic about the future for your asset.
Mm-hmm.
If you are holding a secondary asset in Coventry or Liverpool, you are probably quite worried that you still haven't quite hit the bottom. So depending on what you're targeting, there may still be some value to come off. For other assets, there may be upside. So a detailed look at the markets is crucial.
Let's go a little bit deeper in the office market. The rentals, last couple of years has been quite a nightmare, to be honest. A lot of challenges for the property owners. But we see things changing, right? Can you tell us more details about that?
Well, one of the trends we've noticed more than anything over the last 4 or 5 years is it's the bifurcation of the office market. So at CoStar, we divide our properties into a star rating system from 1 to 5, 1 being the worst quality, 5 being the best quality. And what we've seen is if we take out those 5-star properties, they have seen demand growth, demand gains over the last 5 years. They've seen rental gains over the last 5 years. But if we look at the 1 to 4-star offices, they've seen demand losses and generally much weaker rental growth. So, where you are in your strategy will inform where you want to be on that scale. Because if you're looking for income and growth, you're probably looking at the 5-star offices. But there's a massive opportunity to acquire that secondhand space, that secondary, tertiary, 20, 30-year-old office space that's probably a little bit dilapidated at a big discount to turn around and feed back into the market, maybe as a refurbishment to collect some of that quality that people are looking for.
One information you shared with us during your presentation was about industrial real estate. We see now vacancies increasing slightly. Is it time to stay away? Are we missing anything here, or is it time to go, and buy these assets now? What would you say?
Again, one of the themes that we were chatting about this morning was the nuance in terms of selecting the right assets. So it's true that a lot of those third-party logistics operators and retailers that over-acquired space during the pandemic on the assumption that online retail demand will continue in the same way that it had been during COVID, are having to offload some of that space back to the market. Now, that secondhand space will be competing with itself, so you probably won't see much rental growth there. One of the more interesting points, though, is that a lot of logistics companies and retail warehouse companies operate on a very small profit margin. So if you can deliver a highly sustainable, energy efficient warehouse, where some of these operators will operate on a 2 to 3% profit margin, if you can save them half a percentage point by being sustainable and being energy efficient, it makes an enormous difference to their profits. So there will still probably be strong tenant demand, especially for big box units at the high end, of the high quality end. Secondary stock, again, like offices, may suffer.
Interesting. Now, final question here. I don't know, you don't have a crystal ball, but you have a lot of data and a lot of experience. If you had to look at the 2025, where do you think are we going to be in December? When we finish the year, what will be your predictions for this year?
Yeah, there are sort of two schools of thought to this, really. So, interest rates are still quite high, but they're looking like they're going to come down. Borrowing costs have been coming down, but they're still quite high. So it depends whether you want to be a pessimist or an optimist. I prefer to be an optimist, to be fair. So, we are starting to see the cost of borrowing reduce, which means that there's a very strong correlation between investment turnover and the cost of debt. So we will start seeing investment turnover improve. If you're being a pessimist, you would say the cost of debt is still probably too high to drive a massive recovery in that turnover. But what we've been talking about today is all about whether we're moving in the right direction. And I think in terms of having hit the bottom of the cycle, we generally speaking most certainly have. And most of the evidence we're seeing in terms of the yield compression, the improving demand, the fall in vacancies, fall in cost of debt, shows me that 2025 should be more positive than 2024.
Very interesting. Thank you very much for your conversation. Thank you.
Appreciate it.
which has happened mainly coming from
Good.